Welcome to Taking Stock for the week ending the 20th of May 2022. We're joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share markets. It's great to have you on board, Matt.
Thank you for having me, Kien.
But before we get started, we want to remind you that the information presented today is of a generic nature and does not consider your personal situation. Shares are volatile, and any charts and tables presented today rely on past data and should not be reflective of future performance. So the federal election is on our doorstep with the polls pointing to a Labor victory, but who really knows? Because over the last few years, the polls have been consistently wrong. But the more interesting question is, will the outcome have an impact to the markets? Unlike in 2019, where the Labor government brought forward key policies like ceasing cash refunds for franking credits and halving the capital gains discount, this time around, the modest difference between the two parties suggests little impact to the share markets. In fact, history indicates that there is no relationship in share market performance with any major party winning.
And turning our attention to markets, it's been yet another frustrating and tough week for investors as inflation pressures continue to dominate sentiment. In the US this week, we've seen a number of weaker than expected earnings results from the major department stores, Walmart and Target Corp, with the latter falling some 25% after they reported a significant decline in earnings margins. And this was due to rising costs. So inflation's starting to bite there. The Aussie market has outperformed global peers this year due to its relatively high weighting towards resources and banks, but it has still fallen some 10% from its highs in April. And the US market has fared much worse, falling all year, with the S&P now down some 20%. And as we all know, growth stocks have bore the brunt of much of this selling and are down significantly more. And it's always the case in weak markets, isn't it, Kien? The financial media are focusing their attention on the most bearish commentators and thus creating a negative feedback loop. It's not unusual. It happens every time we see corrections. And it's these moments that test the resolve of seasoned investors. Be greedy when others are fearful. Who coined that? Yes, Warren Buffett. And he's seeing opportunities emerge in the market at the moment. His company, Berkshire Hathaway, has added to its position in Apple stock and have been busy purchasing a position in media giant Paramount Global this week, as well as increasing its position in HP Inc. And this does follow some moves that they made in the previous quarter, where they were increasing their stake in oil companies like Chevron and video game maker Activision Blizzard.
And speaking about opportunities, Matt, over the last year, we've had very low interest rates, and that's led to record merger and acquisition activity. There are now signs that this is slowing down from the impact of rising interest rates, as can be seen with the chart on the screen, which shows a drop in M&A activity in the last quarter. But despite this, the oversold nature of the market has led to some interesting private equity action among our star stocks this week. The first comes from US buyout firm TA Associates, who launched a bid for ex-borderline star growth stock Infomedia with an offer price of $1.70. That's a 33% premium to its last closing share price. Remember, Infomedia sells software as a service to the automotive parts industry. And to us, the bid appears opportunistic and only takes the share price to where it was in October last year. The offer price also remains well below the median analyst price target at around $1.90.
Yeah, the offer does seem a bit light, doesn't it? Particularly given that the company's on track for earnings growth in FY23, and it'll take its ROE to above 17%. So we obviously believe the bid undervalues the potential of the fundamentals. Now, even though the stock is trading at 5 cents below the offer price, these types of opportunistic bids have, in recent times at least, ended without a transaction. So on that basis, we believe investors should probably consider locking in recent gains.
And another takeover story over the week was the potential buyout of borderline star growth stock and transport and logistics company Brambles by private equity giant CVC. But unfortunately, a deal did not emerge and resulted in some volatility to the share price. Now, CVC said it will not be putting forward a proposal nor seeking to conduct due diligence due to the current external market volatility.
Again, it certainly was somewhat of an unusual move. You know, if they were unsettled by external market volatility, then why were they in talks in the first place? But maybe they were a bit unnerved by the media attention and the subsequent share price strength. We don't know. Whatever the reason, it's clear that there is some appeal in the private equity ranks for the business. And the fact that it didn't end with a formal bid, to us at least, doesn't raise any real red flags. Brambles only recently upgraded its earnings guidance in April, and this is reflected in its positive earnings revisions. And continuing on with this theme of mergers and acquisitions, Woolworths this morning have announced a $243 million acquisition of mydeal.com.au. So the news is fresh, so you can refer to our analyst comments to get an understanding of the strategic merit of the deal.
Thanks, Matt. And also over the week, we had slot machine maker and online gaming company Aristocrat Leisure. They released their first half financials, and revenue over the period rose 23%, which was ahead of market expectations. The stock has been under share price pressure over the last year following a significant equity raising and failed takeover bid for UK gaming software supplier Playtech. In the meantime, though, it plans to buy back shares worth about 500 million on the market from around June the 2nd. And this is expected to provide some support for the share price. So perhaps this could represent an opportunity for investors, although those who are trend sensitive should be mindful that it is in a bearish trend on both the SD Max and SD30 TSR.
And looking at our corporate calendar for the week ahead, we potentially have Fisher & Paykel reporting its annual results on Friday the 27th of May. And there are no Star Income stocks going ex-dividend next week.
And with our technical alerts, given the recent volatility in equity markets, it's no surprise to see a higher than average number of signals on Lincoln's technical indicators. For those who are highly trend sensitive, we have the SD Max, which is the Stock Doctor moving average crossover. And on this indicator, we notice bearish signal changes from BHP, Charter Hall Social Infrastructure, Northern Star, and South 32. Meanwhile, CSL and Suncorp, they both issued bullish SD Max trends. On the SD30 TSR, which is the Stock Doctor 30% loss from its highs or gains from its lows, Credit Corp and Metals X, they breach their 30% stop losses. In Under the Microscope this week, we look at global building materials manufacturer and star growth stock James Hardie Industries. The group released its full year result, which was largely in line with guidance. However, despite an earnings upgrade earlier this year, the share price has declined and is now trading in a bearish zone on the SD Max and SD30 TSR, reminding trend-sensitive investors to be out of the stock. But what has prompted the share price weakness, Matt?
Sounding a bit like a broken record on this, I am, Kien. Simply inflation and interest rates. Obviously, they're a building materials company, so there's sensitivity, I guess, to housing starts or housing construction and the subsequent demand for building products. So as interest rates have been rising, the expectation, particularly in the US, which is predominantly where their business lies, is that housing demand will start to slow. And on top of that, investors may be concerned about rising input costs, including energy, raw materials, and other labour and availability of labour. But despite this, James Hardie was able to maintain its net profit. So, Kien, back to you. How did they do this?
Yeah, good question. Over the fourth quarter, management again demonstrated their willingness to put through price rises to tackle the rising costs of inflation. Meanwhile, the company was able to upgrade its earnings guidance by focusing on selling higher value products and also moving towards a direct marketing channel as well. In addition, you've seen strong activity in the renovation and repair segment in the US and Australia, and that's also led to a large backlog of work.
And future growth is also expected to be supported by up to $1.8 billion in capital expenditure out to 2026, which is aimed at increasing both production capacity in the US and fibre cement capacity across Australia and Europe. And earnings forecasts are currently anticipating growth of 34% during FY23.
But one of the key active risks, I think, for James Hardie is that the company has no permanent CEO. But we don't believe this is a major issue because the business has been able to continue to execute on their well-established growth strategy without really any interruptions following the departure of CEO Jack Truong in January 2022. Since then, Independent non-executive director Harold Wines has been the interim CEO, and he has mentioned that the search for a new boss is nearing the final stages. Hence, we remain confident in the business prospects, with the share price weakness a potential long-term opportunity for investors. Gold is often viewed as an inflation hedge, but many of our members are wondering why our gold stocks, like Alkane Resources or Northern Star, have been sold down with the rest of the market despite rising inflationary and geopolitical risks.
That's a good question, Kien. And to understand why our gold stocks specifically have fallen over the last month, we need to understand the drivers of gold demand. Now, although gold has historically performed really well on average during inflationary periods, the gold price isn't perfectly correlated with rising inflation, as this chart on screen indicates. There are other factors that can drive the demand for gold, including seasonal consumer demand, gold production, central bank reserves, the strength of the US dollar, and overall investor sentiment.
Yeah, there's just so many moving parts. But turning to this year, as you can see from the Stock Doctor chart on screen, gold rallied strongly in early 2022 on the back of inflationary pressures, followed by news of the Ukraine and Russia conflict. However, in more recent months, the demand for gold has subsided due to a rising US dollar and the Fed's decision to raise interest rates faster than market expectations. Remember, gold is sensitive to rising US interest rates because it increases the cost of holding the precious metal. Meanwhile, some of the geopolitical risks around a widening Ukraine conflict to include NATO countries has declined after President Putin declared a general mobilization on the 9th of May.
And with gold prices coming down, it's not surprising to see the share prices of gold stocks falling with it. So using the Stock Doctor charting tool, you can compare the gold price in black with gold miners in green. And as you can see, gold stocks tend to be highly leveraged to the gold price. So in other words, it rises more when the gold price goes up and it falls more when the gold price goes down. And investors also need to be a bit mindful that share prices of gold miners may not necessarily move in line with the US dollar gold price over the short term. And this can be due to currency fluctuations or operational risks that are more idiosyncratic. So, for example, Northern Star recently highlighted production outages and rising COVID-related costs, which caused its share price to temporarily break its relationship with the gold price.
So in conclusion, gold stocks can provide a hedge for your portfolio, but performance is not guaranteed. Try to stick to those gold miners that have high quality assets, low operating costs, and an increasing production profile. Also, pay attention to earnings revisions, which provides an indication of the analyst sentiment on the gold price. That's all we have time for today. Thanks, Matt, again for your insights.
Thanks again for having me on, Kien. And hopefully the next time that I join you in a month's time, investor sentiment will have shifted and we can be talking about a stronger recovery in growth stocks.
Yeah, that would be nice, Matt. And with all those opportunities, let's try to make the most of it. And just to remind our investors as well, in our latest Stock Doctor release, we have introduced a new dark mode feature that allows you to change your display and reduce eye strain during the night or in the dark environment. To turn on dark mode in Stock Doctor, click on your username in the right corner of the main toolbar. Then you can switch between light and dark modes. Also, remember to tune in to our Lincoln Live webinar, where Tim Lincoln will return together with Matt and myself, along with Rob Manfrey, to answer your questions on stocks, strategy, and how to use Stock Doctor. We hope you can make it. In the meantime, take care and have a happy, healthy, and prosperous week, everyone.